So firstly, again, thank you very much for joining us today. We really appreciate you taking the time out to learn more about the new banking fellowship offerings. Firstly, let's just start with some housekeeping. I'm sure you've seen the slide that's up, but more importantly, with the disclaimers, it's important for you to note that any views or opinions expressed in this presentation and in the Q&A session are solely those of the authors or presenters and do not necessarily reflect the policies or positions of the International Actuarial Association. That being said now, I would like to kick off the event by introducing our esteemed guest today, Dr. Chris Dakin. For those of you who do not know who Christopher David Dakin is, he is probably one of the most respected actuaries within the profession in this day and age. He is a British actuary and was a long-time civil servant, having headed up the UK's Government Actuarial Department from 1989 to 2007. He's worked across Social Security, pension fund consulting, population projections, risk management, pension reform, and his background is that he studied mathematics at Cambridge University, and he qualified as a fellow with the Institute of Actuaries in 1973, and then he served as the president of the Institute of Actuaries from 1994 to 1996. He was also the president of the International Forum of the Actuarial Association from 96 to 97 and was awarded the Medalist Award from the IAA in 2014. He's also been awarded the Companion of the Order of the Bath, and in 95 he was presented with an Honorary Doctor of Science from the City University of London. There's a long list of other accomplishments and awards he's given, which could take us probably the better part of half an hour. But at this point, I'd like to introduce him to share his remarks. And I guess just before he starts, I just want to mention that the reason we invited him today is because he was one of our early supporters. So more than 3 years ago, we did share some of our content that we've been developing in the banking space with him, and it was just very refreshing to hear a positive take and some valuable feedback that he had for us if we were going to be successful on this journey. So, now more than 3 years later, we've done what seemed an arduous task at the time, and we'd really like to share this moment and I guess achievement with him as our honored guest today. So over to you, Chris.
Thank you, Kudzai. Good morning, good evening, and good afternoon, depending on where in the world you are. I'm speaking from London, where it's early afternoon, and I'm really delighted to have been invited to introduce this webinar featuring the role of actuaries in banking as part of the launch of the Banking Fellowship track for the Actuarial Society of South Africa and the Institute and Faculty of Actuaries. I was involved for many years in the education system of the Institute and faculty, and continued to be involved through the IAA in more recent years. And I'm really excited that the Certificate of Actuarial Banking Practice is going to be made available to actuaries in all full member associations of the IAA, as well as the banking track becoming one of the principal routes to qualifying as an actuary in South Africa, in the UK, and indeed in all the countries where the ASSA and IFoA exams are taken. I have long thought that actuaries should be a natural fit in the banking sector. And indeed, I believe I alluded to that possibility in my presidential address many, many years ago, because I thought actuaries would be able to add real value in the banking area. But historical perceptions and prejudices, both on the part of actuaries and the banking industry itself, have meant that relatively few people have made a success of a career in banking from an actuarial background. A small number of countries buck this trend and have seen significant involvement of actuaries in banking. And it's great to see some of those who have succeeded in doing that, particularly in South Africa, being part of this initiative. In recent times, however, the development of global regulatory requirements for banks with capital modeling and stress testing and the introduction of an international accounting standard, IFRS 9, which requires expected loss accounting, mean that banks are on track to require many of the skills which are already well developed by actuaries in the insurance industry. And so the crossover from insurance to banking is becoming more than ever evident. For fair pricing requirements for products, profit analysis in retail banking pricing also move the banks closer to concepts with which actuaries are very familiar. Other areas well suited to actuaries include asset liability modeling, design of financial instruments and complex securities, modeling of loan portfolios, operational risk, and customer analytics. We have to recognize that there are many in the banking sector who have acquired the necessary skills without being actuaries, but the combination of our overall skill set, a fellowship specialization in applications in the banking sector, and our standing as a global profession with codes of conduct and standards of practice should enhance the possibilities for actuaries to aspire to all sorts of roles in banking, from technical to managerial to board level involvement. Those presenting in the webinar today are among the trailblazing actuaries who have already made a success of a career in banking. And I hope that their testimony will inspire many others to follow this route, so that in years to come, we will see significant numbers of actuaries working in this field of practice. Best wishes to our speakers, and I really wish the whole ASSA IFoA collaboration on this the greatest of success in the months and years ahead. Thank you.
Fantastic. Thank you very much, Chris. And I'll go off on a tangent a bit. I'll take some liberties, and I'll just point out the fact that I'm sure by now you can pick up that Chris is well into his 70s now, as is Ian. And I like to make that point once in a while, I think, to just inspire a younger generation. These are people who have been around much longer, probably been working longer than most of us have been alive, but the intellectual rigor with which they still operate, the curiosity they have, their level of open-mindedness, it never ceases to amaze and inspire me, and has really given me a very different perspective on how to build a career and how to approach I guess life in general. So, just a special thank you to Chris and to Ian to say, you've really supported us and you've shared a lot of wisdom with us on this journey. And we really do appreciate having your support. And yeah, we only hope to be as vibrant as you are when we're your age. So thank you very, very much. I really do appreciate you. So yes, that being said, so I think I'll introduce myself and then hand it over to my fellow panelists. Chris, do feel free to stay on the webinar and hear more about what we plan to share today. But as for myself, so my name is Kadzai Chikiji. I am the chair of the Actuarial Society of South Africa's Banking Committee, and I am also a board member of the IFoA's Finance and Investment Board. And I've really just been running with the team the past 4 years now in trying to secure this deal with the IFoA and also put the team together to deliver the product. So for me, this is an amazing way to end my term. And yeah, I'm so
Kudzai has obviously cut out. Jerome, do you want to introduce yourself?
Yes, I'll go next. Thanks. Okay, so hi everyone. I'm Jerome. I've worked in and around the banking industry for over 10 years. I've worked across retail, commercial, and wholesale banking. I've been involved with the ASSA banking community for over 5 years, heavily involved in education through my volunteering, This includes course materials, syllabus discussions, and examinations. Thank you.
Thanks, Jerome. I'm Ian Allen. I'm from Edinburgh in Scotland, where I am just now. I've been in banking for 30 years. I qualified in 1975, so just a youngster compared to Chris Dakin. In my 30 years in banking, I've had three quite different careers. Firstly, I worked in investment banking for UBS, including 2 years in Tokyo and dealing with central banks. Secondly, I was head of strategy at the Scottish Bank RBS, involved in lots of different activities. And thirdly, over the last 10 years, I've been an independent consulting, helping new banks with applications for banking licenses and their capital and liquidity assessments. Sometimes students say, what should I do? Which of these would you recommend? I couldn't choose between them. I would be happy to do any or all of these again. And one final point on the introduction, picking up from what Chris Dakin said, it's clear bankers are not out looking for actuaries, but in my experience, do not perceive a sense of negativity. In each of my three careers, the label of being an actuary has been welcomed and appreciated. It's not been the reason for doing the job, but it's been respected and appreciated. John, over to you.
Yeah, thanks, Ian. So I started off in a traditional life office. I had 6 years when I qualified with a small life office, Scottish Life. And at that stage, I actually then applied and joined Ian Allen in group strategy at RBS. And from there, I was able to move into the retail bank, and I worked within retail finance, developing pricing models, and which we'll mention later on. And then I moved into data and analytics, where I spent the longest part of my career in RBS, developing customer volume metrics and trying to make the bank understand how to actually interpret its data better, which I think is a great area for actuaries. And just to back up what Ian was saying, when I was there, I was able to bring another 4 actuaries into the bank to join the team and actually replace me when I moved jobs. And the thing that we discovered was that, you know, the banks don't necessarily want actuaries, but they want people with that skill set and that way of thinking. So I think it is a really big opportunity as we go forward.
Christian?
Good day, everyone, or rather say good day, and covers all the time zones. I'm Christian Oppenheim. I'm currently in South Africa, in Johannesburg, the promised land, or the land of milk and honey, as some would say. I worked at a Big Four consulting firm for 4.5 years, and I recently joined a bank in South Africa that specialized in retail banking, and actually planning to expand their business banking portfolio. And I work in the provisioning space, and more recently also in the costing space.
Okay, that takes us to the end of our introduction. Sorry for the technical glitch earlier. My connection, I think, was acting up a little bit there. Okay, at this point, let's get into some of the why. You know, I'm sure many of you have heard actuaries being described as individuals who make financial sense of the future, right? And we can define that in many ways. I've also heard, and as if you have, actuaries manage risk. We're risk experts. There's that as well. Something that's quite common within ASSA is that we like to position ourselves as professionals who serve for the public interest. Public interest is very hot in the South African market as far as actuaries are concerned. And, you know, something that I heard very early on in my career is that actuaries influence financial services and economies. And if you think about all of that, it makes you wonder why we leave out almost half of financial services, which is essentially banking and all banking related services, right? And at this point, I'll hand over to John to give you an idea of what those numbers look like.
Yeah, so this slide is really, hopefully it makes clear why everybody involved with ASSA to produce the banking exam has been so excited about it. So it's actually quite hard to get data on insurance against banking. But what's very clear in this set of data is the size of the opportunity for actuaries looking forward if we consider banking as a career option. This slide specifically for developed economy, it's the US. And the key takeaway is, regardless of how you look at it or measure it, that banking is at least as big an opportunity for employment as insurance. And that's for developed economies. As we look wider to Asia, to South America, where insurance is less developed, then we'll realize that banks are going to be more important for students than they are even in countries like the UK or North America. So move to the next slide. Thanks. So the point of this slide is actually only when I'd moved into banking, when I joined RBS, that I realized just how systemically important and frankly interesting banking is. So banks play an absolutely vital role by their lending to businesses, by their lending to consumers. They very much support economic growth. I'd express this by saying that I believe banks are the beating heart of any capitalist system. But what makes it interesting is the fact that economies and banks influence each other. It's a bit like the insurance cycle. So when economies are performing very well, credit losses are low and bank profitability is very high. But equally, when you go into a recession, you start to get rising credit losses and bank profitability falls. So that in itself would be bad enough. But the real challenge and the real interest is the fact that you have a positive feedback loop working here. So when economies are growing, when they're doing well, credit losses are low, banks increase their lending. And that actually helps the economies grow more, and it reduces credit losses more. So you get this upward cycle that then breaks when things start to go into reverse. So when you start to experience credit losses, you find that banks' profitability falls, and banks quite quickly start to reduce their lending. And as they reduce the lending, it causes an economic contraction. So you actually get a downward spiral on the way down. And frankly, to me, that's what makes banking especially interesting. And the other thing that's great about it, well, it's not great when you're in the middle of a crisis, it's actually pretty terrifying, but every crisis is different. So 2008 is going to be very different from what happens from COVID-19 as banks and the economy, global economies recover. And the challenges that are faced are very much those that actuaries are able to help banks understand and make decisions over. So for me, this is why it's such a big opportunity for actuaries who are interested in banking. Thanks, Gudzai.
Yes, thank you, John. And off of that point, so we've made it clear that the banking space, there's a lot of opportunity. And I can remember early on in my career and thinking, what can I specialize in? You reach a crossroads and you're told you need to choose where you're going. Are you going to life insurance? Are you going to general insurance? And it feels like at some point like a very permanent decision, but you quickly realize that you can actually move around. And as I worked in a couple of these spaces, I specifically worked in life insurance and health insurance before considering banking. I quickly learned about how transferable my skills were across the spaces. And when I did get the opportunity to go work in a bank, I did a bit of research to see had anyone else done this before? Was it possible? And I was pleasantly surprised that one of the leading big banks in South Africa did actually have a large contingent of actuaries working within the bank. I think currently it's over 250, but if we look at the whole of the South African landscape, we have more than 15% of actuarial students and actuaries who are working within banking. That's a significant proportion, even if you compare it to other spaces like healthcare. And in other countries, what I picked up is it wasn't completely uncommon. It's just it wasn't widely spoken about. So in Australia, back then, I think to this day, they have approximately 10% of their actuaries working in banking. Another country, region that I didn't specify here is South America. So within South America, they actually teach a lot of banking principles in the undergraduate actuarial science degrees. And so it's very natural that someone would graduate and they'd start their first job within a bank. It's a very natural transition for them. And at this point, we'll just talk you through what our journey has been in coming to this point. It's a journey that spanned longer than my actual life. So I'll let those who were around at the time speak about what happened in those early days. Over to you, Ian.
Right, good. So I remember the 1980s. In the 1980s, my memory of banking was quite old-fashioned. The banking that I saw in the UK, and I believe in the US was largely branch-based. The branch manager is very important. There was less of a graduate intake. A lot of people went from school down the road, joined a local branch, and if they passed their banking exams, they became a branch manager or a regional manager or an area manager or moved to head office. In the 1980s, many banks went through what they call business re-engineering program, where they reorganized themselves to be customer focused and centralized lots of functions like finance or risk, or in my case, strategy. So when these functions were created, there were more of the sort of jobs in which actuaries would be interested, most obviously in risk. And with the centralization, banks collected their data and used it in central risk management rather than at the local branch manager level. So this was an interesting change. And in this change, lots of the traditional branch managers didn't really feel enthusiastic about the new world, and banks were looking for people. As I said, they weren't looking for actuaries or not looking for actuaries. They were looking for good people to work in teams. And it's perfectly reasonable for an actuary to be part of such a team. And that was the stage at which I became interested in banking and went to RBS, and in the early 90s set up a banking members interest group, and with a friend from Cass Business School, now called Bayes Business School, worked on a session of paper in 98. So I went into banking. Some people did go into banking. Some actuaries who moved in achieved very senior levels. But as Chris Dakin said, their numbers were quite small.
So I then kind of picked up. So I followed Ian into RBS, and I then followed him in picking up, once I was in banking, the chair of the members interest group in banking in the UK. And it was really to try and see if there was a community that we could create of like-minded actuaries in banking, to try and almost follow the route that general insurance had taken. And to try and promote that, we developed actually proposed a syllabus for a banking exam, specifically for the IFoA. And we got as far as putting it forward and submitting it, to try and get approval for a banking exam. But unfortunately, the timing wasn't right, and it wasn't one of the priorities of the profession at the time. And that then really left the door open for ASSA to really push forward and develop the banking exam that we've got today. Good.
Jerome?
Yeah, so going over to the 2000s and the 2010s. So this period sees a growth in the number of actuarial skills working in banking in South Africa. This grew the need even more for a specialized education qualification. And after many years of deliberation and around 2 to 3 years of course development from the team at the time, the ASSA Banking Fellowship Applications course was completed and launched in 2015. The course was developed with experts across the globe, including South Africa and the UK. The first sitting was a memorable exam sitting, in that the first exam had a 0% pass rate. So it was during this period that even more volunteers started coming into the banking community at ASSA, and this drove banking to be one of the more active committees at ASSA. The applications subject was introduced at that time, and it was thought that the principles level subject will be introduced once more banking actuaries pass through the course, the volunteering capacity increased, and the demand of the exam is assessed. Good, sir?
Jerome, you better carry on with 2020s.
Yeah, so the 2020s, this looked at revitalizing the need for looking at a principles level subject in banking. This journey included us at ASSA, working together with the IFoA, in coming up with what an offering would look like. And this partnership then grew into ASSA and IFoA coming up with the different streams, so the principles and the applications level subject. And through a lot of work, this is where we are. And it also included coming up with a certificate in banking practice, which we will chat about later on. I'll just share the slides from my screen. Okay, on this slide, it shows the ASSA banking exam trend over time. It shows the proportions of students attempting the fellowship exams in South Africa. Approximately 400 attempts are done at the fellowship application level per annum in South Africa. The main point that we would like to highlight here is that the accelerated growth in the banking exam, this is now comparable to that of the healthcare exam in South Africa. And in South Africa, the healthcare course has been around for around over 15 years, and banking has caught up quite quickly. Pensions are expected to remain low in South Africa and probably worldwide. On the investment side, historically and currently, the investment exam was taken by those that have been working in banks. So overall, there's really promising growth with the banking exam, and we are hoping to increase this with the IFoA's partnership and with a more international focus.
Great. Jerome, do you mind pressing that the PowerPoint or the share button so that it takes up the whole screen? Thanks so much. So this slide just shows you the GSIBs, or the global systemically important banks. So all that we're trying to say here is that banks really play an integral, or banks are an integral part of any economy, like Dr. John alluded to earlier. And actuaries, we can actually play a role in each and every single one of these banks. We can apply our skills, and we can really add value to each and every single one of these global banks, but also smaller banks, local banks, and also essentially any bank in the world. Thanks, Jerome. So the next slide just shows you that banking is diversified, very diversified. I mean, you obviously have your central banks that oversees the regulatory part in a company, in economy. Then you have your universal banks like the GSIBs that operate across jurisdictions, investment banks providing financial services to their clients, commercial banks operating in both retail and the corporate environments, essentially individuals and companies or businesses, and then pure retail banks, just providing personal and small business services to clients, community banks, especially in community banks, especially operating in the US or United States, that's very focused on a specific area and focused on the clients within that area. And you also have your new banks, and most of these being neo-challenger banks or digital banks, completely branchless, just operating digitally. And they also have your non-banks, companies operating in a payment space that banks would traditionally provide, like PayPal, Chime, and other leasing companies.
Okay, thanks,
Thanks,
Christian. So this slide, I guess the first thing I want to say on this is, I'm very much a traditional actuary, so I was genuinely worried when I first moved over to banking from insurance. The insurance company I worked for was about 1/100th of the size of the bank that I joined. So I had an expectation when I moved over that banks were going to be very sophisticated. Everything they did was going to be in a different order of magnitude. But working in group strategy, I very quickly realized that everything that I knew from insurance as an actuary applied equally well to banking. But what had fundamentally changed was the vocabulary used, to describe, different concepts. Now, within the banking exam, we've solved this by putting a glossary in the opening chapter. And frankly, that alone should help any actuaries who want to try and interview with a bank. Just knowing how you express your knowledge in the way that bankers will understand and be interested in it is, I think, a big part of having the confidence in making that move for anybody who's interested. And just, a couple of examples would be in underwriting, where you've basically got claims in insurance versus credit risk in banking, or indeed provisioning, or is effectively exactly the same as reserving within insurance. And for me, a lot of the work that I did in pricing was then linking up through underwriting, provisioning, reserving, working with those teams to actually then develop the types of models that I was using all the time within insurance. And this is the type of rules you'll get is a theme that Ian's now going to pick up on as we go through the next few slides. Thanks, Jerome.
So Christian mentioned there are lots of large banks, and typically actuaries are going to work for such a bank. Some may choose, as an exciting alternative, to work for small banks. We'll mention in a few minutes as well. This is the overview of a typical large bank. Down the left-hand side, a set of activities. Now, if I hadn't mentioned banking, you as actuaries might have thought it was an insurance company. Very familiar activities. The mix is slightly different. There's obviously much more focus on credit risk here, and we're not bothered about longevity risk. But a lot of activities in dealing with customers and developing products and managing the business are very similar. The way banks are organized, there is not an equivalent of the actuarial function. We talk about 3 lines of defense. The first line of defense would be the risk function in the business unit, and the second line will be in the group function, group risk, and then there's internal audit as a third line. So for many actuaries, the obvious areas to work are in the business unit or group risk function, perhaps with the hope of becoming chief risk officer in a business unit and in the group, or to become NED on the risk committee of a bank. These are obvious routes. But in our presentation, we would not encourage actuaries to limit their aspiration to that. The team who worked on the banking exams have worked in many other areas, and there are many, many areas on the left-hand column where the job is not risk management, but it's very helpful to be an actuary and have a good understanding of the risks associated with the products or the processes in which you're involved. So in the next slide, we tackle a question, okay, there are lots of activities. How do I get into a bank? I think that is the challenge. I repeat, banks are not for or against actuaries. As John and I keep on saying, they're looking for good people, but how do I get started? The experience that John and I had would be very positive. Once you get into a bank, you can get on. Once you get in, they will have internal systems to move to new jobs that become available. Once you're an employee, you can choose, as John did, product pricing or whatever you like, and it's fairly easy to move there. The question is how to get into a bank. The first thing to say is that it probably is different from an insurance route, because in the kind of interviews that we all had in a bank, nobody asks what exams did you pass, and nobody seems to care at all. They have a vague perception being an actuary is very good, but don't really care about the details. What they want to know is what you can do for us. So you have to present yourselves as helping the bank rather than being an actuary. And a second cultural issue is you're not likely in a bank to be working with large numbers in teams of actuaries. You're likely to be working in a multidisciplinary team with PhDs in risk management, accountants, different people, and people who are perhaps less academically qualified, but a huge amount of experience in areas like credit and payments. And the enjoyment and benefit in banking comes from the combination of these skills working together. From my experience, for people who are interested in banking, I would suggest there are two alternative routes, and it depends what kind of person you are, what age and experience you have, and what your interests are. On the left-hand side, you can make a transfer. Chris Dakin talked about regulatory convergence. It's very evident in the UK and relatively straightforward for actuaries to move from insurance into banking, the most obvious area being the one Chris mentioned of provisions for expected losses compared to reserves for claims, IFRS 9. Very obvious area in which actuaries have moved in and there are still opportunities. The right-hand side is more what John was saying about banking always being different and new. So we had the banking crisis of 2008 and staggered out of that. This time it's quite different. This time an obvious issue is customers who've been given a payment holiday during COVID-19, and now how do you assess their probability of default? In the problem solving, there are lots of opportunities in banks. There are always new problems. There are lots at present. The issue here is lower barriers to entry. In the left-hand side, you may be competing with people who have worked in banking for 20 or 30 years, very experienced, very competent. On the right-hand side, the value of past experience is less. These are new problems, the most obvious one today being climate change. So let's look a bit more at each of these two routes. On the next slide, we look at the transfers. In fact, Chris Dakin could have done this slide. He mentioned quite a few of these. We repeat, moving on pricing, as John did, is a very easy, obvious, straightforward thing to do. The same methodology, the same skills. If you get from John the glossary and the terms and banking language and processes, a very easy move. Reserves into provisions, another pretty straightforward move. New, broader opportunities using the same basic skills. Risk model validation. In our team, there are people who've moved from banking to insurance and insurance to banking with different models, but the same process. And the actuarial process is clearly robust, well tried and tested, can add value working with bankers on risk model validation. Enterprise-wide risk management, sometimes I get a bit fed up with the ERM buzzword, but as we found, those of us who worked in banking, bankers in large banks tend to be specialists, most obviously in credit risk or market risk or operational risk or in some specific risks, and they may progress their career by promotion within that risk area. My experience in banking and my colleagues here has been that although we may not be absolute world experts in all types of banking risks, we can get our minds around them pretty quickly. There's nothing amazing or unforeseen or impossible. And it does give us something to offer when we come on to the last two items. In a bank, central issues are the assessment of capital adequacy, allowing for all risks, and asset liability management and liquidity adequacy, allowing for all aspects of the bank. And the fact that we have a training and mindset of understanding all risks makes us well suited to these last two items. So those are examples. There are many others where an actuary could move from insurance to banking. Now on to problem solving. I repeat here this expected credit losses because there's a new issue here. This was introduced only a few years ago, and it was quite a challenge for banks, and many actuarial consultants have been able to work with banks in this area. The problem here is that banks are required under IFRS 9 to make provisions for expected credit losses. If you go into recession, the losses shoot up. If you go into a COVID-19 recession, they absolutely shoot up. But if you come out of the recession, they shoot down again. So it's not just a spreadsheet exercise or even an IFRS 9 accounting exercise. It's really a matter of judgment as to what provisions you could make, allowing for the short-term recession and the longer-term outlook and the probability of default over that period. This is an ongoing area of interest for actuaries who like dealing with numbers, but also like the application of judgment. Still, as Chris Dakin said, a very obvious opportunity for actuaries. On the bottom right is quite a different current example, that since the banking crisis, the Basel regulations have had lots of modifications, and I would say that they do a pretty good job now of setting a framework for the key risks of credit risk and market risk and traditional operational risk. But regulators and the banks themselves are worried about some very large losses that have occurred, regrettably, from conduct risk problems and fines, and also the potential loss from cyber risk and IT failures as banks become more and more online. This is a hot area where many of us like dealing with uncertainty, like solving problems. We don't know the answer, but quantifying the risks and mitigating the risks associated with these, having an actuary in a multidisciplinary team seems a pretty good idea. Now, on the next slide, we show how important this non-financial risk is in banking. This is from the Davos lot, World Economic Forum this year. From the bottom to the top, what bankers are worried about in risks. The details don't matter here at all. Don't bother if you can't read it. Look at the blue blocks. These are the traditional financial risks. Bankers manage them, but are less concerned about them, think they're under control. What jumps off the page are green climate-related risks and how much banks are looking to get their mind round managing and mitigating these risks. Purple risks are also quite strong. These are the IT, cyber kind of risks, and red in the top is the COVID-19 pandemic or things like that. So in looking at banking, we are well trained and the exams help us with the traditional risks. The mindset can be applied to all these boxes about which bankers are worried. Again, I repeat, there's no suggestion that actuaries are better than experienced bankers in addressing these. We're talking about multidisciplinary teams in which actuaries can address interesting and worthwhile problems. Then the next slide, we deal a bit more with some of these issues. On the top left, I'm repeating product pricing. It's something you can easily move into in a transfer, but it's something that's very interesting to them at present because banking is moving into the digital age. Banking has tons of data from current accounts and credit cards. We really know our customers. But with open APIs, fintech entrants, more competition, the pressure on developing innovative products and services and competition is really exciting. So in this area, you could work for a fintech, or you could work for a large bank, which is aware of the threat of disruptive innovation and making sure it doesn't lose its role. So as well as John, Christian, have you worked in product pricing or things to do with it?
Yeah, so to some extent, yes. I mean, currently I'm actually looking at the costing role, and what I learned there was that obviously that influences pricing, right? And also what's interesting about pricing is you need to consider different risks in that space. And also, Ian, if I can just add something else in terms of the skills that we have, something that I also learned very recently was that sometimes just applying common knowledge is actually so powerful. And many times you don't actually see that in different areas. So, I mean, actuaries, we're very technical and analytical, and just having the ability to apply common knowledge to problems adds a lot of value in many different areas.
Yep, I agree. In fact, I've been known to say in a banking context, my mother would have said this actually, sort of common sense. On the bottom left here, we have my nap tip for the day. If I were the age of some of my colleagues here, this is where I would focus at present. So regulators are encouraging or requiring banks in many countries to start to work on climate change stress testing. As Chris Dakin said, this is the same banking and insurance. The regulators in the UK, the relevant papers apply to banking or insurance. So transferring from insurance to banking or banking to insurance is absolutely straightforward. The first thing that we're doing in banking is getting our minds round what we call physical and transition risks, understanding the bank's exposure to those risks and our customers, particularly large customers in areas like oil and gas, autos, airlines, and so on. But clearly the work will be progressing over the next few years into whether banks should hold additional capital for these climate change risks and pricing. John's done a lot more detail work than I've in this, and he would talk about pricing for mortgages, which is often based on loan to value. So if you differentiate between houses that are well insulated and not, you might say they would have different values in future. The mortgage pricing might be different. Banks would manage their risks. And as was discussed in Glasgow and COP26, banks working in the economy would play a role in encouraging a market-driven move to lower carbon use. So I'm sorry I'm not younger and able to get involved in this, but Jerome, you are younger, and I think you are involved in this, aren't you?
That's correct, Ian. So I am currently developing some of the frameworks for climate scenario stress testing and the related analytics at a large bank in South Africa. This bank has a large footprint across Africa. And in-depth or focused climate stress testing exercises are fairly new globally. For example, the South African Reserve Bank did its first common quantitative approach to climate physical risk on its loan book. So this was a common stress test across the South African banks. Similarly, the BOE and ECB have conducted these exercises in their jurisdictions. And I think just the other day, the BCBS has drafted a consultative paper on the principles of climate risk management. That's me.
Thanks. It's a very good area to be in. It's very interesting. It also fits with our aspiration to be working in the public interest. So it's intellectually very interesting and a very worthwhile area. Watching the time on the right, community banks is obvious there are many smaller banks. This is more likely to be a consultancy opportunity where small banks can't have the same level of skills in every area, but having an actuary who can deal with enterprise-wide risk management is a very obvious opportunity. I think it's good that in the world there are small community banks as well as large global banks. Some people want some people want the other. Competition between them is good. And the bottom right, after climate change, the next most important area is the fintechs. We think of banks. Fintechs may be banks or maybe non-banks, but it is a very attractive alternative career to be involved in a startup, working with people who may have PhDs in machine learning. We can bring enough technical skills to work with them. We also have knowledge of products and regulations. Kudzai, you're actually involved in this. So how exciting or how stressful is working for a fintech?
It's both. It's definitely both. So I actually got introduced to the, I guess, general tech space and specifically fintech through the work that I did in banking. So I was specifically hired to work in a digital R&D team, and we developed a lot of, those who are familiar with FMB and its app and a lot of the features under NAV. That's essentially what we developed, and I think when I took the job, I didn't realize that was what it was going to be, because what they knew is that they needed a lot of very good technical skills on the team. So a lot of the work done with pricing, building business cases, pitching for the money, doing the analytics, working with the IT teams on sort of data architecture and reporting back. If you think about it, that's a lot of what you would have done in insurance in any case. So learned a lot. It was a steep learning curve, but a lot of my actuarial skills slotted in very well and were quite appreciated by the team. So since leaving sort of formal corporate banking, I've been mainly working with fintechs across sub-Saharan Africa, and I found everything I've learned as an actuary and specifically within a banking R&D team has served me very well. And, you know, to your point, and I often tell people, banking isn't just about banks. You'll find that the skill set required in a bank is absolutely necessary and required in almost every payments company, in most of these sort of tech companies that work in the asset management space, the investment space, in the loan space. So yeah, if you're interested in tech, banks are looking aggressively for people who have both a combination of technical skills, and by that I mean programming, and quantitative skills, which puts us in a nice sweet spot.
Okay, thanks, Kudzai. So if you remember this slide, you'll actually remember one key message, which is traditional banking is incredibly simple. Now, at its heart, a traditional bank is simply a balance sheet. So if you're a bank, you bring in deposits, which you call liabilities, and you lend them out and you make loans, which are called assets. And if you just think of this picture, it actually highlights the key risks that are involved in being a bank. So you've got credit risk, which is a risk you make a loan and you don't get your money back. You've also got, as a bank, you're operating tens of thousands, potentially millions of individual accounts. And there's the operational risk that you fail to manage those accounts, that something goes wrong with your systems, that people can't access their money. And you also have market risk, which is when you have other assets, it's the risk that the value of some of those other assets fall. So very simple, model for a bank, tells you an awful lot that, you need to know about the risks. And as an actuary, you'll already know how to manage a lot of these risks. So you hold capital against the potential of making losses on the asset side. So you have credit losses in the loan, or you have market risk with your other assets, and you hold capital that protects your depositors. So as an actuary, you're used to the concept of capital. There's nothing difficult to learn there. And again, you hold liquid assets so that if you get a sudden withdrawal of your deposits, you're able to sell these liquid assets and fund those, the withdrawal of your deposits. And again, this very simple picture makes it very clear how a lot of the knowledge you already have as an actuary translates over into banking. So next slide, Kudzai. And the better news for us as actuaries is those aren't the only risks. There's lots of other risks to actually understand and help bankers understand. And some of the details underneath just give a flavor of that. So credit risk that I mentioned earlier, you've got, dig down a layer and you've got counterparty credit risk. And this is very much for things like derivatives, where you've got the risk that the other side of a trade that you make, of say an interest rate swap, starts to get into some difficulty. So you need to worry about the fact that is your counterparty able to honor their obligations in the trades that you've set up and made. You've also got concentration risk. And this, the example I've put down and I kind of think of would be maybe 10% of your assets are held in one way, shape or another in a company like Enron. If it fails, that will very seriously damage your bank if you've concentrated your risk too much. Liquidity risk is very much about customers panicking. There might actually be nothing wrong with your bank. It could be perfectly sound, but there's always a risk that customers are a little bit worried and start to withdraw their money, and that gives you your liquidity risk. And you also have the risk that, again, actuaries would understand that there's a mismatch between your assets and liabilities. In banking, that's implicit. You're always going to have a mismatch. You tend to borrow short and lend long. And the banking exam explores all of these themes and explores how you manage them. And as Ian mentioned earlier, it's possible that you might choose to apply to a bank and work in one of these very specific risk areas, the most obvious being credit risk. But from my own perspective, the thing that makes customers unique against most of the colleagues that I came across in the bank is their ability to bring and understand all of these risks and bring them together so that you can actually apply judgment and explain that judgment to the senior management of a bank. And that's one of the things that, for me, the senior people in a bank valued me as an actuary far more than they would value me just for my technical skills and understanding any of these risks. It was the judgment and explaining that judgment to them. So I think there's tremendous opportunities as we think about our skills in explaining, handling, and making judgment about risks. Thanks, Kujai.
Okay, so we've received a common question around how we decided what goes into the syllabus, and this didn't take place overnight. Aside from the fact that it took a few years to put the initial applications or advanced subject together, when we sat down together beginning of October last year to then put together the new principal subject and the revised applications advanced subject syllabi, we had a lot to already work with. So like I said, firstly, we already had the applications advanced syllabi, but we knew we needed to make some changes. And in addition to that, Ian had already spent 2 years looking at the material and had provided his feedback. And we collected a lot of feedback from the community over the years. We were very aware that there was a lot of principles level information within the applications and advanced exam that needed to be taken out, and there were some gaps in terms of principles knowledge. And so the first thing that we did was we took that feedback and then we sat down and we said, as we know what principles and an applications exam to be, they're split on what is measurement and what is management. So within the principal subject, we're saying, even if you've never worked in a bank, you should be able to sit down with the notes and start to figure out what are some of the core principles that you need to know if you're starting off. But if you are now approaching your applications or advanced level exam, you should be able to operate as an actuary in sort of a silo. You're left alone at work and you need to solve a problem. So clearly there's a different mindset. So we sat down, split the existing F206 exam, which was our fellowship applications exam. We said, this clearly needs to come out. It's principles level, this can stay. And then after we're left with that, we're like, but there's still some gaps to fill. So we introduced additional topics such as product pricing. We added quite a bit of content on market risk management, and we beefed up our operational risk measurement. And there are some additional ones to probably come in the future as we move into the space. And for the applications and advanced level material, we also added a bit more content to I guess come more up to speed with some of the developments that have taken place in the last couple of years, particularly also with the pandemic. So that was really the mindset. A lot of the heavy lifting was done by Christian, who's here with us. We told him what we needed to get done, and then he made it happen. So yeah, as much as this on paper took 5 weeks, it was actually probably a decade worth in the making.
And this slide, it just picks up, it's just an example of one of the chapters in the banking exam. And the chapter itself reflects a lot of the actuarial skills that I brought and I used directly in my job at RBS in pricing in the retail bank. So if you think of loans, for me, it was basically just directly applying discounted cash flow models that I'd already used for life insurance products. More interestingly, I found with deposits was the ability to use concepts like price elasticity and understanding the marginal costs of raising funds really is an interesting challenge that a lot of bankers don't understand. They tend to think about the average cost of deposits when they lend out. But actually, if you're trying to attract an extra 5% more deposits, the cost of that can be very much higher and mean that your extra lending that you funded with that isn't profitable. So as an actuary, you're able to bring together the two different sides of the balance sheet, we talked about earlier. And for me, the key thing to take away from this is there's nothing more complicated if you go into pricing than you've already done. But there's a lot of interesting products that you can apply it to. So credit cards is frankly the most complicated product I've ever thought about. And it's fascinating. You could actually do your entire career in that. So I think as an actuary, just be confident that your skills apply. Thanks, Kujai.
Yeah, so credit risk measurement. So something that we see, and many of the speakers have alluded to it earlier, a major part of a bank that actually is operating, especially in South Africa, where our employed is in IFRS 9, expect the credit losses. And the reason for that is I would say twofold. Firstly is considering that forward-looking view, given that you need to model for forward-looking information, so taking into consideration economic views, building statistical models and adjusting the numbers for that. And then also the PD and LGD modeling, which is very similar to general insurance, where you calculate your claim severity or the probability of something happening, like a probability of default, and then, or rather that's the LGD, loss given default, the severity of how bad it's going to be. And then frequency, which is your probability of default, the chances of that particular event happening. And then also we cover the Basel Pillar 1 minimum capital requirements, or your Pillar 1 risks. We look at standardized versus internal rating based. Essentially standardized is the regulator gives guidance and you apply that to your book. That's typically used in smaller and starter banks. And then your internal ratings based approach, where you may have a capital advantage if you follow that route, where you calculate your capital PDs or probability of defaults and LGDs using internal models that need to be signed off by your regulator. And then we also look at a more recent development from the regulator, credit risk in the trading book, where you need to consider counterparty credit risk or CCR, and then also credit evaluation adjustments. Thanks, Kazaya. Liquidity risk management. So Dr. John alluded to this earlier. Essentially, there's a liquidity coverage ratio or LCR ratio that banks use. And what it's really about is to ensure that you have enough cash to sustain a 30-day cash stressed cash flow event. So, I mean, you have many liquid assets, and can you convert those liquid assets or high quality liquid assets into cash to ensure that you have enough cash to maintain a stressed scenario? So if you think about it, just quickly take you through, you have a deposit book, right? And clients have the ability to draw down on like credit cards. If you have a limit of 100,000 Rand, you've only drawn 50, you can now draw an additional 50,000. And that would require the bank to issue that cash to a client. So yeah, that's essentially just a high level breakdown of the LCR. Thanks, Kasai.
Okay, then on treasury management. So this chapter looks at international best practice of a treasury function. Those that are familiar with the course, the content has been streamlined quite a bit from previous versions. The content looks at the treasury function and possible structures of a treasury function in a bank. It discusses the concepts such as borrowing short and lending long. It also describes the Asset Liability Committee or a Treasury Committee, and how this committee goes to manage and monitor risks and its related concepts in the bank. Some of the related concepts include interest rate risk management, foreign exchange risk, capital, funds transfer pricing, and stress testing.
Then in two other chapters to summarize briefly, on capital management, the Basel regulations, which apply to banks in many countries, have three pillars like Solvency II. Under Pillar 1, you have set requirements for minimum amounts of capital for normal conditions and capital buffers for stress conditions. Under Pillar 2, in the supervisory review process, your national regulator may require additional amounts of capital or additional buffers looking at your stress testing. All of this is pretty straightforward for actuaries. The chapter hopes to guide people through so that they understand the language of banking around capital adequacy, and they understand the expectations of regulators in the ICAP, which is equivalent to an insurance ORSA. This is a very good thing to do in banking, because if you've done the ICAP for a bank, it's covering all their activities and all their material risks, and you really get to understand the banking. It's something you could do as an employee or as a consultant. If you're a consultant and you're doing it for one bank after another, you get really good at it. On strategy obviously ranges from the sort of books you get at airport with lots of words but no numbers, or at the other extreme, an obsession with spreadsheets and Gantt charts. In this chapter, we try to be practical about if you were an actuary, as John and I were, working in the strategy team of a bank, how do you manage the process for the board to approve strategy annually? How do you deal with opportunities and threats that come up? What are the issues in M&A? And are you aware of the current topics, such as we mentioned? So these two chapters come at the end of the course. You've done all the measurement and management, and now you bring it together in two areas that are obviously interesting for actuaries in banking.
Yes, so I'm sure a lot of you are quite curious as to what the education path will look like. So first and foremost, like we mentioned, we tried to align them as closely as possible to the other areas, the other fellowship subjects that are there. And in that also extends to the material. So we have a core set of notes, very similar to what you'd get in the IFoA or ASSA for any of the other subjects. I guess the only difference is that for us, everything is core material. You don't get to not read the bolded out material. We consider every single word core notes. And in addition to that, there's a marking option. So if you want to do extra tutorials and get feedback from someone on the examinations team or someone with a lot more experience, that's available. Because this is a new subject, we will be offering specimen exam papers as well. So the material will come with 2 free specimen exam papers. And as with any other subject, every year we have a mock exam paper before the writing session, a couple of months before the session. So every year there are 2 separate mock papers that you can write and get feedback on. Now, something that we offer for the applications and advanced course is live online tutorials. So that was something that was introduced in the past because we didn't have the principal subject and we understood that would be a big leap. So that is going to continue even though we now do have a principal subject, and sort of off the record, we're looking at doing that for other subject areas as well, because it is quite valuable. Think of it as sort of doing doing case studies in class with experienced individuals from the industry who can talk you through some of the more, I guess, strategic elements of complex solving problems, problem solving within the banking space. Now, something that has garnered quite a bit of interest, we weren't expecting this, is the Certificate in Actuarial Banking Practice. So what we're saying here is that you might already be a fellow. Like myself, I qualified before the subject was available, but I might still be interested in getting formal education and a formal certificate in this space. So even if you're a fellow, you can come back and write the 2 subjects, the principles and the advanced or applications one. And if you pass both of them, you get a certificate in actuarial banking practice. Now, we also understand that the industry and the world is moving much faster than we probably can as large institutions. So we're saying if you're not a member of IFoA, you're not a member of ASSA, we haven't been able to get to your member association, you can still write the 2 exams and you will get a certificate in actuarial banking practice. It will not exempt you from whatever fellowship exams that you need to write in your member association, but it's probably the gap, well, I guess what you need to bridge the gap in your knowledge. And it's something that's accredited, it's recognized both in the UK and South Africa, and probably in a lot of other countries as it grows, and it can help you sort of enter the space. And finally, the ASSA fellowship exams are written in May and October every year, not April and September. So just to bear that in mind, the exams will be written on the same exact day and they are all online. So we do not offer in-person exams unless you have special requirements that you will report. So that being said, there is also a concern around CPD material, and I can tell you this, there's no shortage of banking-related CPD material. The IAA has events right throughout the year. Ian is with us and he's the deputy chair of the IAA Banking Forum, and they actually had an event on the 11th of November as well, and they try to be as inclusive as possible of all jurisdictions as they host those events. The ASSA Banking Committee also has several events throughout the year. We have our flagship seminar, which is focused specifically on banking-related issues, and we also have sessionals throughout the year, and we foresee all of those having an online option into the future. Many of you will know that the IFoA now also has its own banking community, and they host events sometimes on a weekly basis and have different people from across the industry at those events. And if you're an IFoA member, you just send an email, get login details, and you're off to the races. And finally, because we know that this is a particularly new practice area, and because it's a very cross-disciplinary, professional space. Sorry, that's thunder on my side. We do recognize that there's a lot of other relevant material within the banking and finance space, and we encourage you to seek that material out. So if you go to a GOP-sponsored event, by all means, that does count as CPD. And because of the new normative way within which CPD is recorded, all you need to prove is that you learned something and why it's relevant to the work that you do. So please do seek out the events from other spaces and bring those lessons into the lectural space.
As I mentioned that when we started, we didn't think about the certificate, but we think that's a good outcome. Another unexpected good outcome was getting some nudges about banking in the IFoA in the early subjects. In the work we were all doing last year, we benefited from having in the working group some younger people who were still working through these subjects or had qualified quite recently and were very familiar with the courses. And they very kindly went through all the courses and highlighted areas where there were things that were close to banking. And we then wrote paragraphs which didn't require change to the syllabus or content, but gave nudges that students could see the applications of what they learned in banking. Just a few examples. On the top left, CM1 had things about products, including loans and credit cards. It didn't say specifically banking. So we've just nudged about banking products. Similarly, CM2 did talk about provisions for petty credit losses, but didn't have any IFRS 9 or banking context. CB1 mentioned insurance capital and company accounts, but didn't mention the parallels in banking. And at the bottom right, the CB2 did cover the things that John mentioned earlier about banks linked with the economy and causing asset bubbles, occasionally calling banking crisis. So we've been through all the papers and inserted these paragraphs which don't require new technical skills or knowledge, but point to their applications and point to what comes in these banking courses.
Okay, this brings us towards the end. It's clear that a lot of work has gone into this, spanning about a generation's worth. And a lot of people have asked, so, we can relax on, I said we'll relax until about February. There's still a lot more work to do. So firstly is we're going to be looking for more education partners, and we are in constant discussions with other member associations. We've been in discussions for now almost 4 years with India, Australia, as our colleagues in Canada and the US. We're starting to see other countries warm up, and we hope that we'll be able to take the subject to other member associations. We'll also be looking to create more CPD events. I'm always telling people banking is broad. You can't just say banking and it covers everything. I worked in a very different space from everyone else here, and as you've heard, our experience is quite varied. So we want to be able to make sure that we can provide educational content, informal educational content that meets a lot of the different banking functions. Something that's also quite important is engaging employers. So we understand that there are both supply and demand issues here. We want more employers to understand what we bring to the table. There's obviously a responsibility on your part in getting a job and positioning yourself well, but we want to make sure we can bridge that knowledge gap between recruiters and employers and the students that are coming out of universities doing the subject. That's been quite effective in South Africa, and we're hoping to do more of it across Europe, and Asia is engaging with regulators. we found that once the regulator recognized how useful our skill set was, it was probably years worth of pounding the pavement to convince all of the different banks across South Africa that we could actually have value add. So that's something that's going to be quite a priority in some of the other countries. And we've already started doing that work in other African countries. So in a nutshell, it's still day one. We've got a lot of work to do, and we really do appreciate the support of the community. Jerome often says none of this is possible without the community we have. And we've been particularly blessed to have people who are very supportive. And we hope that you'll continue supporting us, whether it's by joining one of the committees, working groups, by doing the subject, by attending these events. We're looking forward to continue engaging with you as we move forward. And with that, yeah, please send through some more questions. I've tried to answer as many as possible in the chat section, but yeah, please do ask any questions that you might have. Don't leave us hanging. Oh, Pedro has a question in the chat. It might have been while my internet was acting up. Oh, I see it now. Can persons with no actuarial background currently working in banking industry also complete the certificate in actuarial banking practice? Okay, Pedro, you've made things awkward. So the current requirement is that you need to be a recognized associate of a full member association that's recognized by the IA. That is the current requirement, right? However, it has come to light that probably the greatest demand is from people who probably did an undergrad and didn't continue. But like you say, they're working in a bank, have a lot of experience, and they want to give it a shot. There are a lot of considerations. For example, we want to make sure we have positive outcomes. We don't want to open sort of Pandora's box around, what does the qualification mean? But we are actually in discussions and considering whether we should amend our prerequisites. So essentially watch the space. I'm not promising anything, but it is something that is currently an ongoing discussion because we understand there's the certificate in climate change coming, there's a certificate in data science, and those don't have stringent requirements. So for a certificate that doesn't provide fellowship status, should there be stringent requirements? Big question mark. I can't answer that right now. What countries are showing appetite for actuarial staff in banking? Maybe Ian, you can start off with this.
I think the answer to the question is 1 South Africa, 2 Australia, and 3 Latin America, isn't it?
Yeah. I mean, I think it's worth mentioning that we are seeing a lot of actuaries in the UK starting to fill some of these posts, within banks.
Yes, in the last year. So I think that's the answer to the question. But in the last year, while we've been working on this, we collectively have come across a lot of people in lots of countries who are working in lots of areas in banking, by no means limited to risk management. So although we may have been very modest about the limited numbers, there are a lot of actuaries in banking in many countries.
Yeah, and I think one of the things we've learned from the IA Banking Forum in the past is that, especially from some of the other countries, I've picked it up in Canada and in the USA as well, is that most actuaries working in banks don't particularly advertise that they're actuaries. It's not because they're ashamed. It's just it's not that important in a bank what the letters behind or in front of your name are. You just need to get on with it. And really what the challenge in the past has been is a lack of community and organized effort. And that's what we're encouraging them to do before they consider formal education options. So you do see them across the globe. It's just, have they reached sort of critical mass and are they organized is the real question, I think, for the profession, for the profession's approach to the subject matter. We've got a question around, I'll come to Sam's point. I've been chatting to him in the chat section, but Kathy brings up the point around supra organizations for actuarial banking staff. Does someone else want to take this, what they've seen with the supras? John?
I think at the moment there isn't, and it's one of the ones that I was very keen to try and create with the members' interest group with banking, was to try and start pulling together, as Ian says, a lot of the people who are actually already actuaries and working in banks. So I think this is something that will emerge with time, and I think the banking exam and actually giving actuaries greater exposure to going into banking, and as we go forward, I think a lot of the challenges and opportunities that exist within banking will attract more actuaries. So I think there probably will be some sort of super organization ultimately. As you get enough actuaries involved with banking, it is the question of critical mass. We've already got, like, Ian's involved with the IAA, and runs a big bit in banking. There is within the IFoA a banking, interest group. So there are some not quite so official super organizations as such. But I think as more actuaries get involved with banking, I expect something like this is going to emerge.
Yeah, I think one of the things I've picked up of sort of the big name supras is probably the only one that ever specifically asks for an actuary, quote unquote, an actuary, is the ILO. And I think that's because they also do a lot of work in the pension space. So they're probably more familiar, but yeah, to your point, you don't really see actuaries being asked for. And I actually did have a discussion with Kathy and a couple of times, and Monique as well, around how one of the challenges, because the supras typically require you to have a master's level degree before they can consider you, in very specific master's level degrees for different posts. And many countries recognize the actuarial fellowship as above a master's level degree, but then in sifting out candidates, they would probably miss all the actuarial candidates because it's not explicitly written there. So one of the things I think the actuarial community needs to do is to get it recognized as having, an equivalent or superior sort of level amongst sort of qualification standards. And I think that might open up a lot more doors for qualified actuaries who are thinking of working in those spaces. Yeah, I think my final point on that is it requires organized effort. The supras, getting them to change things is a lot trickier than getting one bank to change its policies. So you do need organizations like the IFoA, the IAA, ASSA, a lot of the other member associations to galvanize and really band together to put a strong case forward.
Yes, it requires effort, Kudzai, because in our national areas, you have occasion to have contact with your regulator, supervisor, central bank. The reason for speaking to the African Development Bank or the World Bank is less obvious. So I think it requires more leadership from the IAA, because it's similar with the Basel Committee. It's very difficult to turn up on the doorstep of the Basel Committee and have a chat. So I think that I should remind Michael about the need for the IAA to think about that. I think for individual countries, it's quite difficult to think of a pretext for contacting them. I find some students, by the way, interested. Some young students do have a vision of working for the World Bank. And as you say, Kudzai, they recognize that they may need to do an MBA as well as the actual exams to get on the list.
Yeah, it's interesting. They only started recognizing MBAs as master's degrees very recently. So an MBA might not actually still get you in the door. They're very specific degrees they look for. Anyway, so Simon has been making some interesting comments, and I think this sits within sort of your area, Ian and John, around strategy. Now, I've lost track of all the different messages that he sent, but it's essentially, he's been pointing out the role that actuaries can have within strategy setting. And maybe I'll read out his very last point and you can react to that. He says, ability to have bank-wide alignment awareness across the product continuum and functions are highly appreciated. Functions like risk management, technology and enablement, analytics and insights, and revenue or cost efficiency strategies. Do you have any reactions to that?
Yeah, in strategy, as I said, there's no reason why a bank would appoint an actuary to do strategy. But in a competitive runoff, if you're able to do strategy and are an actuary and understand risk, you are likely to win the competition. I didn't quite absorb that shopping list. But I think in doing strategy as an actuary, it's taken for granted that you have numerical, analytical, and problem-solving skills. I never had any reason to pass an exam or be grilled in that. It was taken for granted. My experience was you need, in addition, some kind of social skills. It is unlikely that I would know every detail of payment systems and the difference between a small payment and a large payment and an online and batch payments. You need to communicate with people in payments or credit cards or other products to pick up knowledge that you may not have. And you need to also communicate with, as John said, the senior executives in the bank. So although we do an exam about communication, we're not communicating with other actuaries, and we have to know the language and the way of working in banking. In banking, this multidisciplinary thing is very important. Initially, it may be strange. We may be so used to working with other actuaries and having a shorthand, common language and way of doing things. But looking back at my career, while I can see that works, I can see real benefit in my banking experience in the unexpected views of colleagues from different backgrounds in such teams, and the competition and debate and challenge, and then agreement on the way forward. Another issue in which we're trained is speaking up or raising concerns. I'm not talking about whistleblowing or emotional things, but raising concerns, challenging over-optimistic things. Certainly in a bank, when you're working with from different backgrounds, you have to think about the time and the place and the way of raising concerns so that you're not just seen to be a nuisance. So that requires a bit of thought. And then the final point we all agree from experience in banking is that get to the point. Rather than having a long preamble of technical reasoning and then the conclusion, the way of communicating in banking is to express your view, present your conclusion, and then give the reasoning and then answer questions with more reasoning. So I think it's very good for actuaries to be in strategy. Look at all the failures we've had over the last 20, 30 years in banking. It's arrogant or silly to say actuaries would have avoided them, but I think actuaries in strategy do have a bias towards risk aversion rather than optimism, and do raise challenges and concerns in a sensible way. And I think it is a very interesting opportunity not to be an actuary, but to use all the breadth and range of your actual skills in that area. So I would encourage people to think about it, just make them aware that they will need to learn about how to manage in a bank with that broader range of what I'm calling social skills.
Yeah, and for me in the retail bank, I found it an interesting one. So I headed up, I created teams for product pricing, and then another team in data analytics for customer value. So they would be my day jobs. But what I discovered and what my team found interesting was if anything quite difficult or nasty or strategic came along, I was almost always the person that the bank execs reached to first, because they knew that I'd pulled together a diverse team to be able to do the work I was doing, and was able to actually marshal them to look at some of these more difficult questions. So some of that would be regulatory interventions that suddenly became big ticket numbers. When we're talking potentially of billions of pounds being at stake, how do you defend against it? How do you explain how you're working with customers? Right the way through to actually interpreting the data. So there's a question there about, technology and analytics and insights. So one of the things with customer value is actually how could that change the strategy of the bank? So it's not just creating a metric, it's also helping people understand how to make better decisions off the back of that metric. And even that had its own odd spin-offs, because I had to develop cost models from scratch for both pricing and customer analytics. And suddenly the bit that I probably hated most about my job, but the bank actually valued most in some senses, was the fact that I probably had a better understanding of the costs of the retail bank than anybody else. as a result of that. So again, any discussion that involved that or any strategic decisions, you'd get called on to give some kind of opinion. So I just found that once you were in and people understood the fact that you could think across this very wide breadth of what the bank does and actually understand the bank from start to finish, they would suddenly ask you to get involved in a lot of the strategic questions the bank was facing, because you could pull all of these different dimensions together.
Yeah, thank you very much to both of you for those remarks. I don't know if Christian and Jerome want to add anything before we close off. I don't think they've got any more questions.
Just to echo John and Ian's point, and especially what John mentioned now, also starting to get involved in costing. I mean, it's really not it's not super difficult. It's not a very difficult exercise to do. It's very simple calculations, but to be able to understand the bigger picture, to understand how everything fits together, and then to be able to apply the analytics to a strategic perspective. Not everyone sees that. Like, you might understand the costing of a product, but then we're also able to think further and to apply that into pricing or whatever it may be. So just applying that common sense helps a lot, and especially some of the actuarial subject teaching us to think enterprise-wide. Many times you get individuals who are so siloed in their specific division that they miss the bigger picture, and our ability to bring those different parts together and just apply basic abilities and to question, like Ian said, is very important, from a banking perspective, from what I've experienced.
Jerome?
Yeah, I think from my end, to reiterate from Christian's point on enterprise-wide thinking, for example, on something which I spoke about earlier on climate risk, it's something that affects all risk types in the bank: credit, market, operational, strategic. So, requirement to think quite wide. It's something that actuaries have. It's a skill set that we've got in our toolkit, and it makes it quite easier then to communicate and then establish these links, and then obviously the analytics behind it, and that's in an actuary's toolkit, which makes kind of these assumptions, the projections, quite easy to handle. Thanks.
Super. As you can tell, we can talk about this all day long. This is an area we're not just good at, but we're actually genuinely interested in, and we enjoy hanging out with each other anyway. So if I don't put a stop to this, we'll be here for a couple more hours. Just a big thank you to all of you again for coming, for your support, for your interest in this development. We can't do anything that we've done in the past few years without the wider community, and we really hope that this will have the kind of impact we expect it to, not just for the profession, but I guess for financial services as a whole. And I think it's worth me mentioning that it's been an incredible team. You see a few of us here. The team is over 40 strong, of people who've contributed to the notes. And if we include every other person who's made this happen, it's well over probably 60, maybe 70 something people who've been involved. So again, this has really been an incredible team effort, and if it's going to improve from here, I think we're going to be very successful in making moves in the banking space. Thank you very much to the IAA, Nancy, who's behind the scenes and makes my life very easy. Tandra has joined us from the ASSA office. She is literally a lifesaver, also makes my life very easy. She turns all of my chaos into something that makes sense and that's presentable. So thank you very much. And a lot of you who've joined today are people that we know, we've interacted with. So again, thank you very much for coming and supporting us. And Chris Dakin is still with us. Congrats for making it this long. If you'd like to just quickly pop on screen and give us your, some closing words.
Well, I think it's been very stimulating, and thank you all the speakers for giving us their experience of working in the banking sector. And as I thought and have increasingly believed over the last few years, this is a really important area for actuaries to develop into. And I congratulate the banking group and the ASSA and IFoA for their work on the syllabus, and I hope that there'll be lots of students who want to take this as their specialization, and that many other actuaries will go for the certificate in banking practice, and that we'll see more and more actuaries featuring in this area. And further to Kathy's point, I think it will also enhance our ability to talk to organizations like the Basel Committee and the IAIS and the Financial Stability Board, because actually in those international discussions, banking is a very big piece and generally seen as more important than insurance. So it'll be good if actuaries have a voice there as well.
Great, thank you very much, Chris. And again, we really appreciate you joining us today. We appreciate the support you've given us over the years. It's worth its weight in gold, literally, to have someone as respected as you are supporting us in this development. You really don't understand how much we appreciate having you here today. And yeah, so to everyone else, thank you for staying this long. I know we are 23 minutes over time, so please do enjoy the rest of your day. And we've got 2 more events, one on the 1st of December and another one on the 9th of December. The one on the 1st of December, we've geared it towards individuals in the Far East. So people in Asia, New Zealand, Australia, because of time zones, we obviously can't have one event for everyone. So if you know anyone there, got any contacts, please send this out to them so they can come and ask us live questions. And again, this will all be posted somewhere on the interwebs. You'll be able to find it. Worst case scenario, it's on YouTube University, most underrated learning platform in the world. So yeah, thank you again and take care. Take care of yourselves.